Come on in. It's our monthly Bold Move webinar. Yep. Hey, as you come in, if you enter, the city that you're in the chat box, will help us, the panel here know about where you're at. Maybe there's some special tax benefit for your state that we'll throw into the mix here. So if you come in, go find the chat box. The more we interact, the better, right? You never know, you might have a given that tax time just wrapped up for a lot of people on the personal side, you might have some tax questions. So if you find the chat box, let us know, who you are. And let me take a look at, we're going to spend just 2 minutes, have people come in. We expect a nice sized group today, so it's going to be a lot of fun. Right? Yeah, Pennsylvania, Andrew. I haven't been to Bucks County, I don't think. But I probably should go, right? I got great panelists. I got Jill here, who I worked with for a long time, and she brought Heidi in from her firm, and David and Brian are here, who I just met to do this event. So we got some familiar faces and some new experts. So it's going to be good. I don't know, for those of you who don't know me, I live in Bethesda, Maryland, but I'm from Houston, Texas, and I'm former Army. So there's one thing I don't love. I don't love paying lots of taxes. There's lots of things I do love, but not paying lots of taxes. I'll pay some, but not more than I need to. So hopefully you have the same mindset, right? You'll contribute, pay what you owe, but take advantage of what's available to you. All right, come on in. We've got one more minute. When it clicks to 12:02, I'm going to kick things off. All right. So there we are. We're at the starting line. This is going to be good. So this is our monthly Bold Moves webinar. Every month we look at what's going on and bring in experts to help make us all smarter so that we can run a better business, hopefully one that's more financially profitable, more valuable, and one that has less time constraints so that you don't have the weight of the world on your shoulders. So for those of you who don't know me yet, my name is Kirk. I'm the CEO of Foresight CFO. In addition to this great venture, I teach financial management at Georgetown as a way of helping people do even better. And I was kind of sharing the story when, as people came in, I'm gonna share it again, but a little bit more complete, is when I was a business owner, before I became a CPA, I remember asking my CPA about tax strategy, just wrote the big check and wondering how we can keep more of the big check in our bank account versus the government's bank account. And so imagine, I'm from Texas, even though I live in Bethesda, Maryland now, I'm former Army, and I love lots of things, but I don't love paying lots of taxes, right? And my CPA was really good. She kept us compliance, the accounting numbers were good. And she advised me that the way to reduce my taxes is to accelerate payments to my vendors. By year end, there's less cash in the bank, I pay less taxes. And you can imagine my surprise, right? I want to keep my cash. If there's one thing that helps me sleep at night, is a bank account that's healthy, right? Can you guys relate to, if you can relate, put your message in the chat box, let me know what's going on. Dispersing cash like that is a tax tactic. It's not a tax strategy, right? CPAs are great for making sure that we're tax compliant. Some do financial audits, right, to make sure that the financial statements are mostly accurate so that you can use them to make decisions, so that stakeholders can use them to make decisions. Other CPAs do accounting, but just like a heart doctor is a specialist in the medical field, tax strategy is a specialty in the finance field, right? Some CPAs do become tax strategic experts in one of the areas that we're going to talk about, one or more of the areas that we're going to talk about. Today we have 4 specialists, right? Jill, Brian, Heidi, and David, right? And they're going to talk about the what and the why. So this is the CEO level and also CPA level, the what and why of different tax strategies. And then we're going to highlight 3 areas. Then at the very end, we're going to list other opportunities so you kind of get a full view of the playing field. Just know that there's even more beyond what we're going to talk about, but we pulled out some of the best ones at the very least to get you thinking about what benefit could be there for you. And by benefit, we mean dollars in the bank. So following this this webinar, if anything feels like it might be in the ballpark for you, I really encourage you to talk to one of the experts, right? And if you want a broad overview, you can get on a discovery call with me as a growth CFO, the broad overview, broad thinking. But if you know that one of the tax areas is a benefit to you, I really encourage you to get on the phone with that expert, because they're the ones who'll make it happen with you. So from a Foresight CFO standpoint, this is our purpose, right? We make sure CEOs, we work side by side with CEOs, growing revenue, the bottom line, accelerate cash flow to grow a more valuable business that's not dependent on the time of the owner, so that you have options, right? With both your time and money now. And then to do even better, get a copy of our book that's coming out in August. I mean, the book is written, it's ready to go. Only one thing that's holding us up, and it's paper supply. Can you imagine, right? Even the paper people are backed up. So these are our experts. Each will, when we go into each segment, they're going to introduce themselves, introduce their firm, and then talk about the what and why for each opportunity. And I'm going to kick things off here with Engineered Tax Services with Jill and Heidi.
Good morning, everyone, or good afternoon, depending on where you're located. I'm Jill Mazur, and Kirk is just great at what he does. And thank you for going over tax strategies or tax tactics, Kirk. That was appreciated. So I'm with Engineered Tax Services. We're a national firm, and we work with any industry and any size company as well. Just a real brief history of myself. I am a CPA. I started out in public accounting here in Houston with Price Waterhouse in the dark ages of the Big Eight. And fast forward, I found out about these tax incentives. And a tax incentive is just a way to get you to save money on paying tax. And that's why I love working in this area. So next slide, Kirk, please. Yep. So I deal with a lot of different incentives, but the one I want to talk to you about today is the research and development tax credit. And most people are afraid of that incentive. They hear the word R&D and they just kind of glaze over. So I'm going to make this very interesting because it is such a fabulous incentive that every business should be exploring, and so many are not. So I thought, let's start off with showing you the power of this incentive. So as I said, any industry is really someone that can benefit from the incentive. So here we have one, a custom fabricator. And when we're looking at this incentive, we look at the activities of that business, and we look at the qualifying activities for the R&D tax credit. My firm will come in and actually determine what activities qualify. And then when we're looking at the activities, there's three areas of money, if you will, that we can throw into this R&D bucket because of those qualifying activities. And the big area when we're looking at an activity that qualifies is the labor that went into that activity. So we get to throw labor into the bucket. We get to throw outside consultants into the bucket. So let's say you're doing something, you had to hire an outside firm to tweak something, you didn't have the ability to do so in-house. We can throw that fee, if you will, into the bucket. And then any supplies that were incurred in getting to that unit of first production. So here we have a custom fabricator, qualified wages of 1.4 million, the wages associated with those qualifying activities. We have about $500,000 in supplies. And at the end of the day, we were able to get back this person $193,000 in the form of a tax credit. Next slide. Here we have an engineer, and I always have to laugh at engineers. When I'm talking to an engineer, the first thing I hear all the time is basically, well, we're an engineering firm. We don't do anything that qualifies. And engineers always qualify, even if you have engineers on staff or someone that's doing an engineering type activity, structural, chemical, environmental. Engineers come in at point A to solve a problem, and they need to be at Z. And it's that path that we look at that qualifies for the R&D credit. So here we have wages for those qualifying activities of 1.2 million. Contract research, outside consultants, $500,000. And at the end of the day, we very technically mush those dollars around. We have formulations that we perform with all the dollars that we throw into the bucket. And this firm got back $90,000 at federal and state. I did want to let you know that the R&D tax credit is a federal incentive, but it's also at many, many, many state levels as well. Over 40 states offer some form of the incentive. When we come in and do a study for our clients, we will look at the federal side and the state side. So it's a double benefit, if you will, for the same activity. Next slide, Kirk. Oh, and I'm sorry. And here we have a software developer. Software development is great. Anyone in the IT world, because when we're throwing in labor, usually on those activities, the software IT people get paid higher wages than someone manufacturing a widget. So we can throw a lot more dollars into that bucket. So here we have $4.5 million in wages, computers. This is not computers that Bob and Mary need at their desk. These are computers that had to be leased for a specific activity that they didn't have the power to do so without. So we get to throw that into the bucket as well. And at the end of the day, this firm got back $600,000 in federal and in state. I wanted to mention that when we're looking at the R&D tax credit, we get to look at the current year. So this company in their current year got $600,000, but we can also go back in time. And so the current year, let's say, is 21, if you haven't filed your taxes yet. And we get to look at 20, 19, and 18. And so let's just say a company is getting back $100,000 a year in tax credit. That's now a $400,000 incentive, all things being equal, but you can see the power of this credit in multiple years. Next slide, please.
Well, Joe, let's talk about this for a minute. I mean, that's real money. Is this a one-time benefit, or does it come back every year?
Excellent question. So it's the one-time benefit for the year we're looking at. But if we have a client that we just did 21 for, we can do 22 and so on into the future. So it's now a permanent incentive. It used to not be permanent. It expired every 2 years, which was terrible for tax planning purposes. Yeah. But this incentive changes all the time. And I wanted to mention that because some people are thinking, well, I talked to my CPA a while ago and I didn't qualify. But because of new rules and regulations, you now may be able to qualify. So it's always a good time to readdress with your CPA to see if it's something that should be explored.
It doesn't hurt to recheck. And this is kind of think about this for a minute. I mean, the benefit, I mean, on this example here, $610,000 with all that money goes straight to the bottom line. So your profitability just went up, probably just moved the dial either a little bit or a lot, depending on how big your company is. And then if you're playing chess, not checkers, that $600,000 is you get a multiple of that in your valuation. I mean, at least 6 times, right, in your valuation. And so at that point, it's real money. I mean, you can go retire and build cars. I mean, you start getting financial freedom to do what you want to do, right? You can half retire.
You have to think about how much you would have had to increase your sales at the very top to net another $600,000.
Yeah, I mean, it's significant. Yes. Right. That's why you're up all night.
I love it.
Yeah. So next slide.
Yes. So as I mentioned at the beginning, basically any industry can qualify for the credit. The big ones, manufacturing and software. But when you look at the credit, it's for anything that can get sold, if you will, at the end of the day. So it's not for service companies. So let's say not for a real estate office or an attorney's office, but if you're growing apples or you're developing software, you're making widgets, anything that can basically get sold at the end of the day is an industry that can qualify for the credit.
Well, and Jill, let me comment on that too, because other areas where we see sometimes the credit is not captured is in companies where they're doing internal software development to help improve their internal processes. So maybe they're not building a software platform that they're intending to take to market and go out and sell or sell subscriptions to, but they've spent a lot of resources and time and money in developing a platform to really just figure out how to implement that into their operational structure and improve how they're functioning as a business. And so the cost of that can also qualify for R&D credits. And then, there's a mention here on this list of architects and engineers, which this is where it gets a little bit gray in terms of people's understanding, because their product is ultimately the design of the building that they're designing. So when we have unique and innovative projects, that's where we do see a level of qualifying activity that falls within each of these individual industries. So it's really applicable in really a wide, a very broad spectrum in terms of the verticals we look at with different companies.
Yes, and thank you for that. As an add-on to that, one of my largest clients was a bank for all of their software development that they did internally. And nowadays, when we think about all the apps they could develop for businesses, that's also areas that would qualify for the R&D tax credit.
Yeah.
Thank you.
Jill, if you remember, one of the companies that we looked at together, it was a pre-revenue company. They thought there's no way they could qualify for a tax credit, but the number came out to be just over $600,000, right? Which is, if you're pre-revenue, that's pretty helpful.
Yes, I did want to mention that, and I'll mention it now. When we're looking at the tax credit, it's an offset to income tax. Not every company pays income tax. So if you are in losses, we can take this credit and carry it forward for 20 years. So let's say 21, you were in losses, but you're going to be paying tax in 22. Great to look at. But on that, let's say you are a startup, and most startups are not paying tax. And that kind of ties into what you were saying, Kirk. A startup, they're usually in losses, and a startup is qualified, a company that is making less than 5 million a year in revenue for no more than the last 5 years. That startup can offset their payroll tax. So no matter what kind of entity you are, always something to look at. Thank you.
That's not bad.
Nope, that's pretty darn good.
Yeah.
And so when we're looking at the activities, very simply, it's what a company is doing that's new or improved to itself. In the olden days, you had to have a patent, but not anymore. Now we're just looking at you as your own universe. And so whatever you're doing to develop, design, make something faster, lighter, better, cheaper, that is what we're looking at for the R&D tax credit. It's no longer someone in a lab in a white lab coat. It's out of that world, and just whatever you're doing to yourself to make what you do better.
Yeah. And if you think you might be anywhere in the genre, ask the specialist, find out, because you might be surprised of what's included, right?
Exactly. Yes.
Okay.
So our firm is a licensed engineering firm. And when we do go out and take on a client, it's our engineers that can get into the weeds of that operations and maximize that benefit for that company.
That's why you're called Engineer Tax Services. Right, now it all makes sense. I didn't know that. All right. Okay, so there's something there. I mean, it's a gift that could keep on giving. I like the CFO of me loves recurring benefits, because I can plan on that. I can use that extra money to really build a healthy business, top line and bottom line. So let's bring David and Brian into the picture here. Let's figure out, David and Brian, after what Jill did, I hope you got something really good where there's more money for some of us out there. My bags are empty.
Sure. Well, Kirk, thanks for having us participate. So the Icdis Alliance is a collaboration between the premier Icdis consulting firms, the firm I lead, Export Advisors, and the firm Brian leads, WTP Advisors. We collectively serve over 400 Icdis clients annually and have saved over $500 million in tax savings in total. So next slide, please. So these are some of the primary industries that we serve: aerospace, agriculture, automotive, chemicals, manufacturing, medical, recycling, technology, and then wholesale and distribution. So let's get into some of the more detailed aspect of this. And with that, let me turn it over to Brian, and will you change the slide, please, Kirk?
Thanks, David. A little bit about my background to start. I've been working with this particular export incentive since the mid 1980s, so that might be a little giveaway as to my age. But this incentive has been around a long time. It provided various levels of permanent federal tax savings over the years. It generally doesn't provide any state income tax benefit. But like I said, I've been working with this since the mid 80s. I spent, like Jill, I joined the profession when there were 8 big firms. So I was with Ernst & Winnie in the big 8. And then we merged with Arthur Young, and it became Arthur Young. And I worked in the Chicago and the Milwaukee offices for many years. And I've been working in the sort of a boutique independent fashion for the last 15 years. And, you know, like David, I'm very excited that we've been able to put this DISC alliance together because the sum of the parts is greater than the whole.
Hey, Brian, can I just give my background real quick since I forgot?
Sure.
So I also joined one of the big 8 firms back at the time. I joined Arthur Anderson. I was in the audit practice. Enron was my main client. None of what they did made any sense to me, so I thought I should migrate over to the tax side. I'm based here in Houston, Kirk's hometown.
Okay, thanks, David. Yeah, I just had to close the door because there's some construction going on outside. So I apologize if that got in the background. Anyway, let's talk a little bit about the benefit of the Icdis, because it can vary depending upon how your client or you are organized. If you're a pass-through entity, you can save about 6% off your federal tax bill with regard to your export profits. And if you're a C corporation, that could range anywhere from 13.125% up to 21% as a potential benefit from using the Icdis. And the Icdis, like I said, it is a permanent, it does provide a permanent benefit. There's no time value of money. This drops right to the bottom line. I know that's important to Kirk. And and it's something that can continue on year after year after year after year. But it doesn't come without some complexity. So let me talk a little bit about that. So the DISC itself is a tax-exempt separate C corporation that most likely earns a commission when the operating business makes an export sale. And, or it's possible, and I've seen it, where sometimes the Icdis purchases goods and resells them for export. And then that's another way that the DISC can make a profit. And in some cases, if a company is a pure distributor, they could set their business up as a DISC. And simply, as long as everything is for export, and there are businesses that have that profile, they can simply run their business as a DISC, and they'll pay tax only when profits leave the DISC. Otherwise, they could actually operate for a long time and pay 0 tax, unless they make dividends from the DISC to themselves. But generally, the way the DISC earns its profit is that it earns a commission of the greater of generally 50% of the net profit on the export sales, or 4% of the sales. But that 4% method is further limited to net profit for a business that has a very skinny bottom line. And in one area to really enhance the benefits associated with the DISC is to look at the calculation as opposed to a simple approach, look at it on a transaction by transaction approach. And that's really where we add a lot of value to our clients. We have world-class software to do these calculations, and we've got world-class expertise to perform the calculations. So that combination there can greatly enhance that DISC benefit. And we'll get into an example a little later, but you'll see exactly how that works. The DISC commission itself becomes a deduction on the operating company or the related supplier, as it's called in this world. And then the DISC doesn't pay tax, but when it pays a dividend, they're taxed as qualified dividends to the DISC shareholders. So that's where the benefit comes in, because the qualified dividends are taxed at 20%, and the S corp or partnership income for the pass-through entity might be taxed as low as 29.6% after the 20% pass-through deduction. But it's possible certain businesses don't get that deduction, and then that rate spread could be as great as 17%. Next slide, please. Okay, and there are some very specific requirements to be an Icdis. There has to be a new entity formed under state law, and it has to be a corporation. It cannot be an LLC. Then within 90 days, a DISC election needs to be made with the IRS to elect to be a DISC. This entity can only have one class of stock. It has to have a par value or stated value of at least $2,500. There has to be a separate set of books and records for the DISC. And then the last two tests are the two that really trip people up and sometimes cause problems. And if you do get tripped up, it can disqualify the DISC, and therefore all the benefits are lost. So it's very important not to get tripped up. 95% or more of the gross receipts, the DISC that are qualified export receipts, that's pretty easy to meet. You just make sure that really the only income is the commission that it receives. And every so often we'll run into a DISC where somebody has a checking account with $2,500 and it's earning interest. And let's say it earns a nickel of interest, which sounds smart on its face. You don't want to have that money not earning something. But then if there's no DISC commission for some reason, that nickel of interest will disqualify the DISC. So it's a very delicate tightrope walk between, smart money management and let's make sure this doesn't get disqualified inadvertently. And then the last test is a 95% qualified export asset test. And basically what that means is that at the end of each DISC year, the DISC has to have a balance sheet that qualifies under the tax law. And if for some reason there was $1 million of cash in your DISC, that's probably not going to qualify because your DISC doesn't need that much cash. So it's always important to monitor the cash that's in the DISC and other assets that may be booked on the DISC books, because just like that 95% receipts test, this test could inadvertently disqualify the DISC as well.
Yeah.
Okay, so next slide, please. Okay, and then what qualifies for Icdis benefits? Mainly it has to do with exporting property, although certain services do qualify. So, but if I import a good from China and I turn around and export it, that's not what qualifies. This incentive was intended to promote US manufacturing jobs. So goods that have been manufactured, produced, grown, or extracted in the US, and then also meet a content test, those are the goods that qualify for DISC benefits when they're exported. So something that a widget that I'm building in my factory with US labor and US content, that is going to be what qualifies. You can have some imported materials, but there are limits on what qualifies. And also in the service area, all architectural and engineering services can qualify for DISC benefits. And that's regardless of where the project is performed. Whether you set up an office in the UK to do the work there, or you do the work in the US somewhere, it doesn't matter. All those projects can qualify. And then the last item you have to satisfy is you have to be able to prove to the IRS that you did export or that somebody exported these goods on your behalf. You meet those tests and your DISC is qualified. Per the last slide, you're entitled to this incentive.
Yeah.
So Kirk, do we have time for a quick example?
Definitely.
So first off, we have a lot of clients in the recycling business. So let's just look at a typical scenario where, let's say they had 30 million of revenue Brian, and let's say they had 10 million of that was exports, and they had, say, 2 million of taxable income. Well, our industry average in that recycling industry, that commission averages 13% of export sales. So for this example, that means the commission they'd be able to pay would be 1.3 million. So that 1.3 million is going to be a deductible expense. So that's going to lower their ordinary income from 2 million to 700,000. Is that right, Brian?
That is correct, yes.
And then that money will come back then as dividend income. And in this example, we're assuming it's a flow through that would own the disc. And so that money would come right back to the disc as qualified dividend income. So the tax savings from that would be anywhere from about 6%. So 6% of 1.3 million is, I think, about 80,000, up to potentially as much as a couple $100,000.
And let me point out that what David is describing is a situation with a transaction by transaction analysis. And because in the scrap industry or recycling industry, what we often see are companies with a lot of volume and not a large percentage bottom line. So maybe the bottom line is 1, 2, or 3% of sales. And without the transaction by transaction analysis, this $1.3 million disc commission that David just described would be $100,000, $200,000, or $300,000. It'd be significantly less.
Yeah. Yeah. So to bring it back to, the what and why from CEO standpoint, here's the takeaway is if you're exporting products that are made mostly in the USA and certain services like on the screen, agriculture and engineering services for foreign projects, then there's a potentially a 13% benefit for your taxes for that set of work. If you're in that genre, it's worth having the experts take a look at it just to figure it out, and to to kind of highlight some things. When we start working with a client, and when we repeat it every year with an existing client, we do about 20 hours of what we call financial health check. We're looking for this type of things plus cost saving. We're looking for found money, because the sooner we get you to break even, the sooner the CEO feels like the smartest person in the room. So if you're exporting, there's a good chance that there's found money if you're not already doing exactly what was just talked about. If you're not.
One other point, if I could make it, what David described was a current year situation. If we identify a company that has a disc and they haven't done the transaction by transaction analysis, we can go back and look at prior years as well.
Yeah, fantastic. I did not know that.
My last question for Brian is, this sounds like it's all pretty complicated. It sounds like there's a lot of moving parts. Am I going to have to get, my attorney involved and my CPA involved and a whole bunch of people, or is it simpler than that if you work with the Icdis Alliance?
Yeah, so a lot simpler than that. So the Icdis Alliance can provide a turnkey solution in the Icdis area. We, some of us are attorneys. We can establish a corporation and do all the work necessary to perfect that disc collection and have that entity in good shape going forward so that it qualifies. And then some of us are number crunchers and data aholics, I can call them.
Yeah.
And so we can do everything from A to Z when it comes to the Icdis.
That's a great point. You got the how covered, it's turnkey. This is the CEO wants to benefit, but this is not CEO work. I mean, that's good point. Is there anything else before we jump into Heidi's section?
I don't think so.
Good. Okay, Heidi, let's get into real estate. A lot of businesses own property, so how can we make that property work even better for us financially?
Yeah, absolutely. Well, it's really interesting because the current tax code is so geared towards supporting businesses or individuals who choose to invest in real estate or invest in other types of infrastructure. It's not really only real estate. Of course, we know that with 100% bonus depreciation, individuals who go out and purchase equipment or vehicles or even jets. That's something we actually focus on as well as private jet acquisition. There are these tremendous tax benefits to essentially incentivize people to spend money, which is driving our GDP, it's driving infrastructure, and overall driving our economic growth and stabilization, right? And so that tax code carries over to real estate as well. And cost segregation right now is one of the most significant benefits that a real estate investor can apply. And as CPAs or CFOs with a company, when a piece of property is acquired, it is so important to look at the potential benefits of how shifting the depreciation, accelerating that depreciation based on component types can be so dramatic in terms of the tax benefit to the client. And one comparison that I oftentimes will provide to a client when explaining the concept is that when we look at the whole building as a single purchase, as you see on this image on the left side, that's essentially our standard deduction. That would be like a taxpayer claiming their 1040 EZ, taking their standard deduction, very simple, no documentation required. And when we then shift to the other method on the right-hand side, it's just a different accounting method is what it is. And we have the option allowable by the IRS to choose to itemize our deductions. And typically, in many cases, or for some taxpayers, if we itemize deductions, that might get us a higher deduction than just that standard. But you have to have the documentation. It's just, again, the difference between a 1040 EZ and your 1040 with itemized deductions. We need receipts, we need backup, we have to have the data to support those additional sort of breaking out of the components in that. So cost segregation is ultimately doing exactly that. Instead of treating a building as one single asset, we can look at that building and break out everything that a taxpayer acquired. And we're saying, look, we didn't just buy one building as a 39-year asset. We purchased a number of different assets, and there may be flooring, carpeting, cabinetry, appliances, light fixtures, all of these different components. And if we understand essentially what the taxpayer paid for each of those individual assets, then we can put those into different class lives. And with bonus depreciation, anything with a class life shorter than 20 years becomes fully deductible under the bonus depreciation rules. And so the numbers are staggering. We have a couple of case studies that we'll show you, but let's kind of roll through some of these slides and I'll show you a little bit more of some of the benefits. It's important to understand that cost segregation is pretty applicable to all property types in a number of different situations. We have people ask us a lot, well, I don't know if my property qualifies, or I don't know if this is a good fit or not. And we'll do a little bit of education from the stance that it's not about whether you qualify or don't qualify. It's really looking at what the percentage of reclassification that we can accelerate would be. And then secondarily, how can that particular taxpayer benefit from that increase in depreciation? So we're looking at applying cost segregation today on everything from new construction projects, major renovation projects, existing properties. So buying an existing building, we can still claim bonus depreciation on those assets we shift out. New acquisitions as well as old acquisitions. I think a lot of people still don't realize that you can do cost segregation on a property that a taxpayer purchased 5 years ago or 6 or 7 years ago, because it's not subject to the statute of limitations and it does not require amended returns. And so the cost segregation can actually be placed up onto the current tax return using a change of accounting method, a 3115, with prior approval, automatic consent. So it's not a red flag item. It's not an audit trigger. And they can take all of that adjusted depreciation in the first year. And so all of these situations, two really big ones that we still see people don't realize is when there's a step up in basis. Maybe a partner buys another partner out of a building partnership. Maybe there's inheritance and a family leaves their building through an estate to their children. They get a step up in basis and are able to apply the cost segregation in that scenario as well, and also on 1031 exchanges. So a lot of application in terms of how we can optimize the depreciation in almost any type of real estate situation, as well as any type of real estate as well. So we'll roll through next slide. And the way that the cost segregation works, we still will hear occasionally some people say, well, it's just a timing difference. And why would I pay a fee to have this done, knowing that I'm going to have this depreciation anyway? Well, I mean, I always use the comparison that if I win the lottery and they say, wow, you just won $1 million. I'm going to give you $5,000 a year for the next 40 years. Or how about I give you $1 million today? And
I like that one.
yeah, right. That's typically where I'm at. I'm like, well, I feel like I could invest that money and I could do a lot more with it. They give me $5,000 and that's probably going to go buy groceries and, fix a couple things at the house. So it's gone. So the timing difference is substantial. And we look at the time value of money, and the ability to reinvest those funds certainly allows us to be able to then increase that money by having it now instead of 40 years from now. We also then can take bonus depreciation because of the reclassification. We can sometimes reduce property taxes based on how we're allocating these assets. We can actually maximize the sale. And this is a big one. I'm not going to dive into the details because we could talk about this for an hour, but people always ask, well, if I do this and sell the property, I have to hold the property for 3 or 4 or 5 years before I sell, or I'll be hit with recapture. And that is a whole nother discussion. But the amazing thing is we can utilize the cost segregation to reduce the tax implications upon the sale of the property. So that's all. Again, I'll just give you that little breadcrumb. So if you have additional questions, or we can do another webinar on that one, but there's really some strategy behind it that is extremely valuable for a taxpayer. So next slide.
Heidi, I have a question.
Go for it.
Are there people who love doing this kind of work?
No, not at all. We don't get passionate about this at all.
Yeah. I'm a CPA, and I'm glad there's people like you who can dig into the details. I just want more money in the bank, right? And but you guys got it covered.
Yeah, this people also ask, well, my CPA takes care of things like this for me. This is where your CPA isn't going to take care of doing cost segregation, because the engineering that goes behind it to break out these building components, you have to have very specialized knowledge. And Jill is a CPA, I'm an accountant, and we're not doing it either. It's our engineers who are actually doing site visits to break out those components. So let's continue to roll through the slides.
It's a different expertise.
Yes. Yeah, exactly. So when you look at some of these case studies, this is saying 5-year tax savings, but in reality, now with bonus depreciation, this is first-year tax savings. So, if we've got an $18 million apartment complex, we could be looking at a $1.5 million first-year tax deduction or tax savings. The deduction's actually significantly higher because we're calculating that against an estimated effective tax rate. And so saving $1.5 million in taxes in the first year, that's a real number that we're seeing with people who are buying real estate. You can look at these other examples. This office building literally saved the client over $600,000 in taxes the year they bought the building. This hotel, $812,000 in taxes year one. So obviously this is also subject to how much income this entity has, because the depreciation is reducing income. But the losses that are in excess of income carry forward. So we don't lose those. We're essentially using this in stockpiling. I say, hey, it's kind of like we have a bucket of depreciation that we can sort of pull all of this out of as we're earning money, and we're non-taxable until we get to that limit of where we've accelerated that depreciation. So the benefit's really, really drastic.
Yeah.
Next slide.
I mean, that's real money, and if you're going to use it to fix up the house, you can fix a lot of things in the house with that kind of money. So really good point, Kirk. And to that, before we talk about this energy stuff, we're doing more and more. The market has changed pretty significantly over the last couple of years. It's been so interesting. We do over 300 site visits a month across the United States.
So we are looking at a lot of real estate. We're looking at a lot of buildings. And one of the big shifts that we've seen is investors buying single family rental properties and buying Airbnb properties and, these single family houses that, used to be that cost seg was apartments and offices and hotels and, those buildings you saw on the previous slide. But anymore, we're seeing this is actually applicable for an individual who just bought a rental home. And if we're looking at let's call it a $300,000 purchase, we have to allocate something to land. But if we're taking a land allocation and then reclassifying, let's call it 28% on a $300,000 rental property, we're averaging about $65,000 to $70,000 in additional depreciation in the first year. So $300,000 purchase, and it's almost a $70,000 write-off year one. So just imagine that scenario for a taxpayer who's got a lot of taxable income. This investment, the benefit of it changes pretty significantly when you factor that type of benefit in from the tax saving aspect. The ROI is shifted. It changes and improves all of the numbers for the project as a whole. So we have seen it really since the Tax Cuts and Jobs Act was passed, and they started this bonus depreciation for existing buildings. It's really, really incredible to see the numbers.
Yeah, and Alex asked exactly that question, does it apply to individuals? And yes, it does. I mean, if you don't take the benefit, you're just leaving money on the table. And if that's what you want to do, so be it, right? So let's talk about energy.
Yeah, absolutely. So two other incentives, again, tying to real estate. We talked about the cost segregation, which is really generating the significant depreciation and accelerated benefit. From there, then, we also typically are looking to see if anything would qualify from an energy efficiency standpoint. There are two incentives for buildings that are efficient, and they both apply to either new construction as well as to renovations. So whether someone has purchased an existing building and they go do a retrofit and switch to, say, LED lighting, which we see all over the map, or they're building something ground up, we see this left on the table all the time. But 179D is a deduction, and this is specifically applicable to commercial buildings and multifamily projects that are 4 stories and higher. So just on the multifamily side, it's high rise, but for any other project type, it's any commercial building can qualify for 179D. And what it is it's $1.80 per square foot for either new construction or for renovations that meet the energy requirements as being efficient. They do require testing, it requires certification. So we do the energy modeling to do that so they can capture the deduction. And then people always say, well, how much is that? What's the cost? And we're typically between 4 to 8 cents a square foot to capture $1.80 a square foot tax benefit. So it's a pretty reasonable price point.
That's better than my 10-to-1 ratio that I look for. So that's not bad.
Yeah.
Hey, let's step on the gas a little bit. I want to make sure we land on time.
Yeah.
But we're doing good.
Yeah, absolutely. So this just kind of breaks out 179D farther, 60 cents for lighting, 60 cents for HVAC, 60 cents for building envelope. So if someone's just doing an LED retrofit, they would just claim the 60 cents a square foot, as opposed to new construction, we'd be looking at the full $1.80. So just case in point, keep it in mind, if you have a client who builds a building or has renovated a building, that should be a trigger to recognize a potential benefit. The next slide, I think we're going to talk about, let's bump down to the 45L credit. I think we have next. Maybe one more. We'll pass you guys can look at these case studies in your off time. We'll send the slides. But the 45L credit is a second one, which is a tax credit. And the 45L is multifamily units that are 3 stories or lower. So single family homes or multifamily 3 stories and lower. And 45L is a $2,000 tax credit per unit. So when we're looking at, say, someone who's building a new multifamily development and it's got 100 units, we're looking at a $200,000 tax credit for that developer who constructed that project. Again, it gets left on the table all the time, but it is really, really significant for people who are in this particular space. So keep that one in mind. So cost segregation, 170/90, 45L, really, really significant benefits. And then we can kind of wrap up from there. And I think, Kirk, you've got some last closing things to touch on, right?
It's really, it's worth saying that if you have a building, you guys have a solution where you can put attendants on it and get paid more money. So, I mean, if you have a building, it's worth looking at.
Yeah.
And just to bring it home for everybody, I mean, so we're talking about R&D tax, which applies to a lot more things than what a lot of us think about, think it would. If you're exporting products made in the USA, mostly made in the USA, and some services, there's something there for you. And then real estate, there's a lot there. There's a lot of different components of real estate. Then in addition, for everybody else, there are certain states that don't have a state income tax. And if you're like me, Florida's looking pretty good. Even though I'm from Texas, Florida's looking pretty good. And shoot, the tax savings, I'm a modest man. The tax savings alone will pay for my place in Florida. So what am I doing here in Maryland? Because Maryland's not friendly, right? But that's for everybody, something to think about, right? When you sell your business, too many business owners, they sell their business, they get the big check, and they got to cut another big check to the state. If you get ahead of it, if you do some of this tax strategy, you don't have to, right? You at least have options. Some other things to think about, there's the work opportunity tax credit, where basically if you hire veterans like me, you can also hire felons and other people, but I don't like putting veterans and felons in the same sentence for some reason. But there's more to it than what I'm showing on this one-liner. There's employee retention tax credits. You know about that from the pandemic through September last year, 21. There's captive insurance, where basically you self-insure through somewhat of a complicated vehicle, but it's turnkey if it's a good fit for you. Conservation easements. When you sell your business, there's deferred sales trust. We're not taking all the money on the same day where you got to cut the same check. You get paid out over time. And then there's family trust. There's other things you can do to transfer your wealth multi generations. That's tax preferred versus writing the biggest check you can. So all this, we're coming in for landing right on time. That financial flight plan, getting you right there. So we're going to send out the slide deck to everybody, plus recording. And the first few slides in, you'll see everybody's contact information. Plus, if you want to talk about your total business, what your flight plan is, where you want to end up, I'm a good person to talk to about that. So contact us. Pretty sure if you're in the genre, if you want a better business, that your time will be well spent. You'll get more out of it than you can possibly imagine. So with that, does anybody from the panel have any departing comments before we adjourn the meeting? Everyone good? Thumbs up? Okay, thank you for joining me. I'm glad that you're the expert and you're doing this kind of work. You make it easy for people like me. And thank you so much, all of you. I mean, Jill, Heidi, Brian, David, thank you. All right, and see you guys soon.
Thanks so much.
Okay, bye, everyone.
Meeting adjourned.